these were steady numbers in what was a seasonally weak quarter for the company, as well as an uncertain macro environment. So the constant currency growth at 2% was higher than the 1.5% that the street was anticipating. So that is a big positive. In terms of the dollar revenue, it's gone up by 0.3%. Margins have been flat on a quarter-on-quarter basis at 26%, and the management holds on to its margin guidance band of 26 to 28% going ahead as well. Profits have seen an increase of about 3% on a quarter-on-quarter basis. A positive was the recovery in a couple of the two key verticals, BFSI and retail, which contribute over 50% to their revenues, where there was softness in the prior quarter, so that has recovered fairly well. On expected lines, India business performance was very strong at 10% plus and contributed nearly 25% to the incremental revenue, but we knew about that deferred contract from Q2 to Q3. In this quarter, the company faced headwinds in the form of the communications vertical in UK and softness in the healthcare vertical in US, but the management says that both of these are one-offs. Digital too has seen a pickup. It now contributes about 16.8% to their overall revenues. On a quarter-on-quarter basis, it's an increase of about 6.6%, 30% increase seen on a year-on-year basis. So that too, as a cylinder, is firing quite well. In the conference call, the management sounded fairly upbeat on the demand environment, though they do acknowledge that H-1B visa is going to be a risk, though they are taking steps to mitigate it in the form of increasing their local hiring, etc.
All right. And what are the brokerages making of the numbers reported by them?
Well, CLSA says it's a solid Q3 amid a CEO change. They managed to beat the top line in a seasonally weak quarter. They exuded a more positive outlook on BFSI and retail, and they sounded they sounded of stability in their recent problem areas. CEO Chandra's elevation to the Tata Sons and TCS share is a loss to the company, but they believe that the incoming CEO and COO can preserve the company's successful operating structure, so they retain their high conviction buy with the target price of 28.50. Kotak says that the top line increase was aided by a sharp increase in the pass-through element, so the equipment and software expenses went up by $65 million on a sequential basis. With respect to the potential risk pertaining to immigration reforms, Kotak says that, it's still work in progress according to the company. They've stepped up local hiring. They're reviewing all the available levers to reduce their visa dependency. The setup for the calendar year appears to be more promising, even as growth will be back-ended. The key drivers will be higher IT spends in BFS and retail. They have a reduced rating on the stock. The valuations are not attractive considering the potential visa rule changes and the business mix that is more weighted towards the traditional services where we are seeing elevated deflationary pressures. DB says the leadership transition to test the operating structure and performance, but the earnings were fairly okay. So positive demand outlook, H-1B visa remains a risk. They have a buy rating with a target price of 3,200.